Did you know that most ETFs are commission-free when traded online? In addition, Vanguard ETF expense ratios are as low as 0.09%. Many features make both passively and actively managed ETFs profitable. For today's video, we will visit Exchange-Traded Funds for Beginners, Best ETF Investing Explained 2022. ETF stands for Exchange-Traded Fund. ETFs are an excellent way to invest in a wide range of bonds or shares in one package. Typically, ETFs track a specific market, like the FTSE 100 in the UK or S&P 500 in the US. ETFs are tax-efficient investment choices and can be highly affordable with little expense ratios and commissions. Since we are zoning on ETF investing for beginners, we will introduce the two types of ETFs: passive and active ETFs. To begin, ETFs can be passively or actively managed. Passive ETFs are a replica of a specific diversified index. For instance, passively managed ETFs could be focused on the S&P 500 or a specific sector, like the gold mining stocks. These ETFs do not require any activity from the investor. They perform as long as the market is also performing. On the other hand, actively managed ETFs have a manager taking decisions based on risks and market conditions. The portfolio manager decided what securities should be included in the portfolio, rather than accept everything in the index. While this makes more sense at the risk aspect, it could be more expensive than a passive ETF. There are many options if you decide to follow through with active ETFs. Here are some of them. Bond ETFs. Bond ETFs are where one gets regular income. Students and people mostly patronize them in retirement. Although anyone who wants a regular income can sign up for one.
For my retirement.
If the underlying bonds perform well, you will receive a sufficient income regularly. The state, municipality, government, and corporate establishments issue bonds. ETFs bonds do not have a maturity date. They are, however, treated like a loan to the organization and traded at a premium or discount. Another premium source of investing in ETFs is in commodities. Gold is the oldest form of investment, as that used to be the measure of wealth in government-backed currencies worldwide. Today, you do not have to own the commodity, just shares in companies that do. We will share that shortly. Stock ETFs. Stock ETFs are also called equity ETFs due to their potential for growth in the securities traded. Stock ETFs are a compilation of stocks in a single sector or industry. For example, if you want a stock ETF in automotive, your actual investments might be spread across Tesla, Ford Motors, Jeep, Chrysler, etc. That way, your portfolio is diversified within the industry. A smart choice is to mix new entrants with potential and high performers to maximize all growth opportunities. If you invested in Tesla a decade ago, when they were still building their brand, today you would own equity in the most valuable car company worldwide. Another advantage of stock ETFs is that their fees are lower than other investment forms like mutual funds, commodity ETFs. Perhaps you might have guessed what this is by the name. Commodity ETFs spread your money in the commodities market. As we have exemplified, your money could go into gold or crude oil. We all know that commodities are the least affected regardless of how bad the economy gets. If anything, crude prices have gone up since inflation. You will hedge well against inflation when the market takes a downturn. Also, since these are expensive properties, holding shares is less expensive than owning the actual commodity. You do not have to worry about storage costs. Not to talk of being mugged on the subway while returning home with your gold bars in a duffel bag. That could easily end anyone up in the Squid Game sequel. Currency ETFs. Currency ETFs track the performance of currency pairs consisting of domestic and foreign currencies. Again, currency ETFs serve as a speculation yardstick on currencies prices based on a country's political and economic developments. In addition, if there is volatility in the forex markets, currency ETF hedges importers from exorbitant prices. In fact, most currency ETFs prevent inflation. Of course, currency ETFs include cryptocurrency. Currently, Bitcoin ETFs are issued for companies with some interaction with crypto. The SEC is still considering what to do concerning allowing every hedge fund manager to include crypto. The SEC said crypto is highly volatile and can be easily manipulated. I guess they are referring to Elon Musk tweets as manipulations. Leveraged ETFs. A leveraged ETF gives returns in multiples. For example, if the return says it is a 3 times leverage ETF, then once the S&P 500 rises by 1%, you will get a 3% return. Should it fall by 1%, you will lose 3% of your value.
Yeah. How risky would that be?
These inversed multiple returns can sometimes take shape with future contracts and options available for potential growth. Subscribe to this channel and multiply our numbers for exponential growth, like leveraged ETFs. Suppose you have decided whether to choose an active or passively managed ETF. You could look through some of the best ETFs for beginners. Do not be surprised when Vanguard ETFs are all you see in your research, and they are the most recommended for beginners based on their expenses and performance. However, what makes one ETF better than the other? Here are key points to consider. 3. Expenses. Expenses are the administrative costs of your investment. One must research and ensure they buy into the lowest expense ratio available. If you are investing in an actively managed ETF, ensure that the returns are strong enough to cover the costs of the high fees. If you get a 1% expense ratio, that is $10 off each $1,000 investment. Vanguard ETFs expense ratios are lower than 1%. If you are paying less for the cost of investing, you might be pleased to avoid commissions on each trade. Most companies are offering ETFs as commission-free packages, and we will get to that shortly. 2. Holdings. Comparing the holdings of different ETFs can help determine the performance. Sometimes performance now is not an indication of the future, but it could be a metric compared to other ETFs. 1. Commissions. Many ETFs are commission-free when traded online, including Vanguard ETFs. Most investment companies have given up on fees to attract more customers, following Fidelity's path.
I'm excited.
However, some still have commissions that could be too much per trade. The investigations should reveal that. In case you missed it, we share the backstory of BlackRock, their start as a response to an unsatisfactory job, and their status as the king of ETFs. Check out how BlackRock became the king of ETF